Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS. Today I'd like to talk to you about oil. The oil price has been rising since February and recently hit the highest level in almost a year. But I think it's in for a tumble. I expect the price to fall back probably into the $30 barrel range in the not too distant future. That's because I expect supply to increase with no place to put it. First off, why have prices been rising? As far as I can tell, it's mostly because supplies have fallen recently. But much of that reduction is only temporary. Meanwhile, there are structural increases in supply that are gradually kicking in. Now, Nigeria and Canada are the main sources of supply disruption. Nigerian output has hit a 27-year low as people who object very strongly to their drilling program keep blowing up oil pipelines. In Canada, meanwhile, the wildfires around Alberta shut down a lot of output. Separately, Libya is having problems exporting owing to the instability there. And to top it all off, U.S. production has been falling to 8.7 million barrels a day recently from 9.3 million barrels a day average in 2015. I think, though, that the Canadian and U.S. production could recover rather quickly. First off, the wildfires have apparently been brought under control and production could start to recover. Secondly, with prices at current levels, it's now economic to exploit many of the several thousand drilled but uncompleted, or DUC wells, in the U.S. Oil companies will probably start completing these wells as sentiment improves, and production is likely to increase over the next several months, in my humble opinion. The U.S. rig count, the number of oil rigs in use, has stopped falling, as has the number of oil wells spudded, in other words, the number of wells that they've started to drill. This suggests that U.S. output is likely to stabilize at least. Separately, Iran has said it plans to continue boosting its production further. Nigeria and Libya, though, they may take some time to recover. Meanwhile, there's plenty of oil available above the ground. Not only are U.S. inventories still near record levels, but there's an enormous amount of oil being stored on ships, waiting to find a buyer. For example, a few weeks ago, Reuters reported that there were 40 supertankers anchored offshore Singapore for use as floating storage. There are almost as many waiting offshore Texas as well, an almost unprecedented level. More than 100 million barrels of oil are said to be floating on the sea as the oil industry runs out of room on land to store it. Now, this traffic jam of oil tankers is a sign that actually there's still a global supply glut of oil. Problem is, it costs money to store oil like this. It costs about $40,000 a day to charter a very large crude carrier that can hold 2 million barrels of oil. That works out to $7.30 a year to store 1 barrel. But if a trader buys oil now and tries to hedge his position in the futures market, he can only lock in a profit over 1 year of around $2.50, meaning he'll lose nearly $5 a barrel in this trade. How long are traders going to hold on to these losing positions? A lot of oil may be released into the market in the not too distant future. That's why I think the current rally in oil prices is based on speculation, not fundamentals, and is likely to peter out in the near future. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.